Before we start, I would want you to hit that red subscribe button so you never miss out on any of our videos, and comment down below saying I subscribe to enter this one shout out giveaway. Hey guys, what's up? Welcome back to Entrepreneur Pod. Investing in real estate refers to any property owned solely for the purpose of generating profit, either through rental income or through market value appreciation. There is no such thing as no money down in real estate because the money has to come from some source. If you want to invest in real estate with little or no money, you need to develop the ability to recognize, understand, and even take advantage of other people's money. In today's video, we will be telling you how to get in real estate with little to no money. Purchase money mortgage, seller financing. The first proven way to invest in real estate with no money is through seller financing. When buyers are unable to secure a loan from financial institutions, they may opt to seek real estate financing from the sellers. With conventional real estate transactions, the buyers will provide the sellers with the cash to gain ownership of the property. However, with a purchase money mortgage, the seller extends finances to the buyer. The buyers will then repay the sellers with respect to the agreed terms. Investing in real estate through lease option. The second proven way to invest in real estate with no money is through a lease option. Under the lease option, the property owner charges the buyer a monthly or yearly premium in the form of higher rental payments. The excess rental fee will then be channeled towards the purchase price. With this type of agreement, the investor is able to purchase an investment real estate using a slightly higher rental fee. Hard money lenders. Unlike private money, hard money lenders set forth fees in the form of points. Ranging from 3 to 5, these points represent an added upfront percentage fee based on the borrowed amount. This is on top of the interest rates hard money lenders charge, which range between 10 and 18%. Fees and interest rates are not universal with hard or private money lenders, so investors need to do their due diligence. Equity partnerships. A very common path in real estate investment is through partnerships. What one investor lacks, the other can make up for, and many partnerships will entail one partner finding a distressed property at a discounted price, while the other one uses their credit score and working capital to finance it. Just make sure everyone is bringing something to the table. For better investors, aspects such as goals, risks, roles, and returns should always be discussed before creating any type of partnership. Home equity. An alternative option for investors with no upfront money is home equity. This can be a viable option since property values have gone up in recent months, meaning there could be more capital available than you think. For investors looking to capitalize on this route, there are generally two options: rewrite the first mortgage into a cash out refinance, or keep the first loan in place and add a home equity line of credit. Option to buy. Sometimes referred to as a lease option, this method allows investors to acquire properties without initially taking legal ownership. However, the investor will sign a legal option to buy from the homeowner at a specific price in the future. In return, the investor rents the property out on a long-term basis with an agreement in place to purchase the property at a later date for a previously set amount. Buy a duplex and live in one unit while you rent out the other one. Did you know that you can finance a 2-unit duplex with an FHA loan? As of March 2015, the down payment requirement for an owner-occupied duplex was only 3.5%. You live in one unit and rent out the other real estate property for extra cash. In addition to the low down payment requirement, the beauty of this real estate investing strategy is that the rent you derive from the other side of the duplex will probably pay a good portion of your mortgage. By owning shares of real estate investment trusts. A REIT is a real estate investment trust. REITs have a number of advantages, the foremost being liquidity. If you own 20% of an apartment building, you cannot get your money out unless someone else buys your share or the property is sold. When you own shares in a real estate trust, it is generally as easily sold like shares of stock. You can buy targeted real estate investment trusts such as those in firms that build medical buildings, nursing homes, malls, and industrial parks. It is easier to diversify your holdings by owning a variety of REITs, and you never have to manage anything. The modest downside is that they take a chunk of the profits and administrative overhead before distributing the remainder to shareholders. A related financial product is a real estate mutual fund. These mutual funds are more liquid than REIT shares. They are more diversified too. They may invest in REITs, the publicly traded shares of home builders, and companies that sell building supplies. Real estate ETFs are simply ETFs that invest in the same sorts of businesses. A REIT ETF is an ETF that invests in REITs. You'll have lower returns, but there is less risk than investing in an REIT. In every case, you don't have to invest in real estate directly, much less manage it. This brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so you don't miss out on any of our videos in the future. Also, watch a few videos that are on your screen because I'm sure you'll love them. With that, I'll see you in the next video.